Everyone, and welcome to this video call on the launch of SATCO Capital Tru Blu PMS. Firstly, thank you very much for taking the time out and joining us in a time when there is flood of webinar invitations. We hope to make it worthwhile for your time today. My name is Deepak Jaggi and I head SATCO Wealth, a group company of SATCO Capital Markets. Since there are many partners who are joining us for the first time, I would like to give a brief about the company background. SATCO Capital Markets is a SEBI registered capital and commodity market intermediary. It's a member of NSE, BSE, NCX and NCDEX. We are also depository participants with CDSL and have PMS registration. Commencing business in 1994, SATCO has strong presence amongst retail, HNI and NRI clientele. SATCO has over 22,000 registered client base and over 10,000 demat account holders. SATCO Capital is also present in various parts of the country through its franchisee offices. Our today's speaker is Mr. Nitin Raheja. Nitin is a veteran of the capital markets and has over 27 years of experience, of which last 20 years have been in managing funds for mutual funds, family offices, and HNI clients. He has worked in established financial entities like Enam Securities, Sun F&C Mutual Fund, and Dawnay Financial Services, where he was CIO for the Offshore Fund and Domestic PMS. Nitin is currently managing SATCO Growth and Momentum PMS since its inception in January 2012 and has done exceedingly well. Our flagship PMS has delivered 29.9% CAGR return vis-a-vis 13% CAGR for benchmark, which is CNX 500. Nitin and team have been working on this new PMS strategy called Tru Blu for some time now, and for the benefit of our clients have put up a very strong case for it. To talk about this new strategy, I now invite Nitin to take it over from here. We would like to take Q&A after Nitin's presentation. Thank you, and over to you, Nitin.
Thank you, Deepak. A very, very good afternoon to all of you all. And thank you for giving us your valuable time on a Saturday afternoon as such. As Deepak just mentioned, we in SATCO PMS have been running one scheme for the last 9 years. We all finished 9 years on December 31st and have refrained from, launching many schemes just for the purpose of raising AUM. Still, we believed in a strong conviction in our product. And that's also because our existing product has been delivering exemplary returns. And if you look at it over periods of time, it has consistently got ranked within its peer group among the top quartile as such. As Deepak mentioned, our growth and momentum PMS, which essentially is a bottom-up multi-cap stock picking approach-oriented scheme, has delivered 29.9%. And that has been based on the fact that it has a simple philosophy. It's a high growth oriented scheme. So we look for companies who are looking to double their profitability every 4 years in that scheme. And we are cap agnostic, but it has, by its very nature and because of the high growth parameters that we set out there, it's got a mid to small cap bias as such. Having said that, in the last 6 months, which have been fantastic and beyond everybody's own expectation in the way the markets have behaved and the kind of returns that investors have earned, right from the beginning, and this has been based on a wave of skepticism on the entire rally and the sustainability of the entire rally. And hence, we've been getting asked this question right from July, August, when the market started running up. Is this sustainable? What will happen? And so on and so forth. So that sort of forced us, we were sort of, while introspecting internally and trying to answer client questions, it kind of forced us to, we went back to the drawing board and we started doing our own research. So what did we look for? We said, look, assuming that what is the major fear that every client has, right? That am I investing at the top of the market? And if I invest at the top of the market, what will happen? And so on and so forth. So we said, okay, can we identify these so-called top of the markets or drawdowns that typically take place in the markets, which are severe? And we went looking back right up to 2008 when we had the whole global financial crisis. And what we saw is that we could identify four major drawdowns that took place in these last 12 years. And they typically happened. And when we defined drawdowns, we defined them in terms of 24 to 25% plus. Intermittently, there are normally many drawdowns of 10% and so on and so forth, which happen in markets, but they happen even in bull markets and so on and so forth. And they happen, and you had a few of them happening between 2002 and 2003 and 2008, when we had a big bull run. So we said, let's look for the major drawdowns, and let's look for the fact that assuming you had bought or got into markets at the peak in each of those drawdowns, what would you yet have a few stocks which would have done well when the markets came down and then again came back and to their original level? So which means that the markets delivered virtually flat returns. Were there stocks which would have actually shown a 15% CAGR return? And to our own surprise, when we looked at the CNX 500 index, on an average, we found that there were anywhere between 80 to 100 names that would come out in each of these four drawdowns. And there were four drawdowns, as I mentioned to you, 2008, 2011, 12, 2016, and then now 2020. And so we found 80 to 100 names. So the next step, which we said is, okay, what are the defining attributes of these companies who have been able to deliver 15% CAGR while the market has been flat? And we found, not surprising, but attributes of growth, attributes of return, efficiency of capital, and so return on how the companies deployed capital and what sort of returns they made. That got us thinking that what if, as investors have been sort of worried and uncomfortable, what if we sort of create a portfolio of the top names in India using some of these attributes? And we kept on fine-tuning these attributes and so on and so forth. And we basically shortlisted 3 to 4 major attributes based on which we would create these portfolios. So that, in a genesis, gave birth to what we call as the Tru Blu portfolio. The other thought process behind this was, many often clients come and say, oh, well, I want to have blue chips in my portfolio. And there are blue chip mutual funds and so on and so forth. And a lot of clients even buy single stocks and so on. So but they come back and saying that, look, I invested in a blue chip. It's not done well for me. And that is essentially led by two attributes. That blue chips, typically, most blue chips, there are a few which show consistent growth pattern, but most blue chips, due to the high base effect, generally have been known to deliver their stock returns in compressed periods of time. So we said, can we identify those periods of time and basically invest in those blue chips at that period of time so as to generate alpha for the portfolio? And hence we created what we believe is a rules-based approach to blue chip investing in the form of the Tru Blu portfolio. I have a short presentation that I will run you through, which will give you the genesis of what we do in that and what kind of returns have we found that approach can yield. Right. So just a quick overview. In SATCO, we have a policy where we have an investment committee which oversees the investment manager, which meets at regular intervals to vet the investment decisions, to provide suggestions, and it is comprised of, again, people of considerable experience and expertise. Besides me, there is Mr. Naresh Tejwani, who is the former chairman and director of the ANMI as such. And he has been a veteran himself, a stockbroker and a director in SATCO for many, many years as such. Mr. Rajendra Bhavani, who is the promoter, owner of SATCO Capital Markets, again a very old, 2 decades old member of the exchange. And then we have an independent member, Mr. Anmol Sekri. Mr. Anmol Sekri is virtually known as we have gone around and when we talk to people in industry, everybody in industry seems to know him by virtue of the fact that he runs a valuation company, and all corporates and especially the finance arm of corporates have approached him at some time or the other for valuing either businesses or assets and so on and so forth. Further, Mr. Sekri, in his own personal light, is a very, very large investor and a very successful investor. In fact, if you go and search for him in terms of a number of blue chip companies, you will see his name in the top HNI list and so on and so forth. So extremely astute and shrewd investor, having seen many, many decades of experience in the market. So coming to the blue chip scheme. So we said, let's go, blue chip as a term is used very loosely. We said, let's go to the root of and try and define what is blue chip. So we went and looked up Investopedia. And Investopedia defines blue chip is any company which is nationally recognized and well established and financially sound. They generally have high quality, widely accepted products, and further, they are known to weather downturns and operate profitably in the face of adverse economic conditions, which is why they are able to deliver stable returns and so on and so forth. So this is blue chip, and coincidentally, valuations of blue chips don't come cheap, and the reason being, as it comes, the name blue chip actually emanated from a game of poker in which the blue chip is the highest value coin. So which basically means blue chips are companies which are well known, which have firmly established business models, which have consistency of delivery, and that is the genesis of our portfolio philosophy. So, what is the Tru Blu's rules-based approach? So, in the Tru Blu rules-based approach, what we do is we typically what we did is we went back the last 10 years, and over a period of 10 years, we said which are the companies which would have delivered growth in 2-year periods. So, say for example, when we went to 2010, we looked at 2010 to 12 and said which are the companies which delivered growth. Second, so the entire 200 universe would typically we saw get narrowed down to about 60 companies based on our criteria. Further, then we said, where is the efficiency of capital the most? We saw that list would come down to roughly around 45 names. Further, we would create further filters of cash flow, of management quality, and we would typically see that in every known period, there would be about 35 to 40 names that come out as such. So what we did is, in our numbers and our analysis, we said, what if you had invested in these 35, 40 names for the next 1 year? How would that portfolio perform? And similarly, so we did that for periods of 10 to 12, 11 to 13, 12 to 14, 13 to 15. So for 9 periods, we did it and said, what would a portfolio based on the last 2-year numbers, if created based on that, perform in the next 1 year? And the rationale for that also was that typically when companies are growing, they go through growth cycles. And these cycles, when they typically happen, a virtuous cycle typically lasts for 3 to 4 years. So the objective was to get a company which is in that cycle and invest in it at that point of time. So Tru Blu, as it stands for, looks at true growth, return on capital, cash flows, balance sheet strength. What we found is They stand for low volatility, and they have unmatched asset management quality. How is the portfolio constructed? Typically, we take the S&P BSE 200 as our universe, and we run these filters to create the model, and so on and so forth. This is done based on a quarterly and a half-yearly testing basis, as such, where these proprietary indicators are run. And once we have our 35-40 companies, our research and analysis that we do typically helps us to identify the best of the lot, as such. So a portfolio will typically consist of anywhere between 15 to 20 stocks. Max concentration will not exceed 10% in any stock. We found that the average market capitalization of these companies would have been about 40,000 crores. And the volatility is showing as 25%, but it's actually lower because this has got skewed by the figures that we saw in the current year. When we ran this portfolio for the last, as I mentioned to you, 9 years, the returns we found were exemplary. What we found is that every single period of time, this portfolio had outperformed its benchmark. Starting from year one, and these numbers that you see are 1st June to 1st June. You might ask why 1st June? The reason being that we were running these numbers for the year end, 31st March, and we said that between April and May, all results come through. So we would create the portfolio on the 1st of June. And that's how we arrived at these numbers. So typically, in the first year, the market gave a 0% return. This portfolio would have given a 40% return. Next year, the market gave 25. This gave 38. 17, 64. Very interestingly, we found has been the ability and the resilience of this portfolio to withstand downturns. So hence, in say the year 4, when the market gave a negative 2%, this gave 6%. Subsequent year, again, you can see outperformance. And again, the big year, the 1920 year, when there was the big downturns, if you remember, I talked to you about those big downturns. So 15-16 was one, 1920 is the other one, where the markets came down 18%. When I say 18%, mind you, don't make I'm referring to 1st June to 1st June, because a lot of you might think that, well, March, the market fell more. It's not 31st March, it's 1st June, as I said. So there's an 18% downturn in markets, while this portfolio only delivered -2%. So as you can see, consistency of return, low volatility of returns has been an attribute of this portfolio. Going further, a 10 rupee invested, NAV in this portfolio would have gone to 72 during this period of time. While if you had invested in the index, you would have given 22. So, a far bigger outperformance by any yardstick. We also looked at it in terms of, as I mentioned to you earlier, to see how it performed in short duration periods. And you can see on a 3-year period, when if you really look at the market return, it has been pretty anemic as such. How did the portfolio perform? It far outperformed the market by a wide degree, as you can see. Even on a 1-year chart, as you can see, the NAV was outperforming it significantly. What we further did is that, as I mentioned to you, there were about 35 to 40 names that would typically come up in the portfolio at any given point of time. We said, look, we are not creating, so when we ran our backtest numbers, we were doing it for the entire 35-40 universe. We said, what if we don't touch the 35-40? Because we are running a PMS, we are not running a mutual fund. What if we were to take the top 20 names out of that list? And out here, we did not exercise any discretion. We just did it based on pure ranking. So you said, if we do that, what would it throw? And what we saw is that top 20 name portfolio would even show a higher return of almost close to 10 rupees going to 89 rupees. So almost it was virtually like a 20% plus higher number over the entire portfolio, and so on and so forth. Just want to share with you, we said, let's look at what would have been the type of companies that this portfolio would have had, what would have been the type of companies, and then we said what would have, at each period, this chart tells you which was the winners and which were the losers as such. And this is just pure raw data. We haven't done any sort of filtering mechanism. Say, for example, in our existing portfolios, and something which we plan to follow even in this, we have an approach where we have a stop loss based approach, where if a stock comes down 20%, we hit the stop loss. We did nothing of that sort out here. We said just let it show that. However, we do plan to follow a disciplined stop loss oriented approach in the existing model, and so on and so forth. So as you can see, the kind of names across time periods are all the well-known names which have delivered very, very handsome returns. So, for example, if I were to show you, say just last year, starting from bottom up, you have a Divi's, you have HDFC Asset Management, Nestle, Indraprastha Gas, Whirlpool, and so on and so forth. In the prior year, you have Bata, Bajaj, ICICI, Lombard, Muthoot Finance, UPL. So all names which would evoke a great deal of comfort investing, that look, that markets in the short term can be volatile, but when you are invested in these names, these companies are not going away anywhere. They are not going to suddenly throw up something negative. I might also point out to you that when we were doing this model and companies got thrown up in this model, we did create an exclusion list for ourselves. In the exclusion list, for example, we removed all the PSUs, because in our view PSUs have not delivered numbers, excluding a few PSUs which I think are what I would call as the second generation run PSUs, which are more efficiently run, like companies like Indraprastha Gas or a Gujarat Gas, or which was not a PSU earlier but has been in the last few years, or for example a Power Grid, and so on and so forth. Those were the exclusions, but by and large we removed all the PSU banks except State Bank of India. We removed the cyclical businesses because we don't think we are good at forecasting cyclical businesses. So we applied those filters, and sort of that reduced the universe down to known and proven names in the portfolio across the time horizons. We also tested the portfolio's performance during tough times. Like I mentioned, 15-16 was a tough time between March 15 and September 16. What did we find here? That while the markets corrected 19.4% during this period of time, the Tru Blu model had a drawdown of hardly 4.5%. And once the markets bounced back, this bounced back much more, by almost 7-8% in the terms of outperformance. So, so highlighting the point that we made, the portfolio has remarkable resilience during tough periods as such. So even if there is a fear of a correction happening, this portfolio falls less. And historically, history has shown that if you're able to manage downturns well, the upturns take care of you for yourself. Similarly, the performance of the portfolio during this period, during the COVID, when the markets fell 31.5% between Jan to November, this period is for, this portfolio fell 26% and then bounced back in line with the markets. So again here, it collected that outperformance by reducing the intensity of the fall. So once again, sort of highlighting the resilience of the portfolio. So all in all, I would like to end this by saying that we think that we believe that if you are an investor who wants to invest in the capital in the equity markets, however have a lower tolerance for risk, investing in blue chips using this model is probably the way for you to go forward. We believe, and if you do the maths in terms of the returns over a period of time, it translates into a very nice 25-26% compounded return that we have seen Of course, the first 2-3 years were very high. So even if you adjust for that, it's a very, very handsome return, far in excess of what the market has been able to deliver. So as I mentioned, the approach is discipline. It is model based. There are rules which govern it, and we think, and we are very, very, very confident of how we see this portfolio doing going ahead. Thank you. Uh, Deepak, Jay.
Thanks, Nitin. We can start with the question answer round. I invite participants to use the Q&A box for their questions. Nitin, the first question is in. Have you fixed any minimum benchmark like minimum growth or ROC for the last 5-10 years?
Yes, we have, and that is the basis of running the model.
I think they want a little bit more specific in terms of the numbers.
Yeah.
So if you can give us a ballpark.
Yeah. So typically, if you ask me, the way we look at it is that we see what we did really was we ran this over a period of time for companies which were showing more than 15% growth as such, and even in terms of the ROCs, we typically ran it for anywhere between 16 to 17% plus.
Right. The next question is in, would you have taken a stop loss approach the way market corrected in March 2020? Most of the stocks corrected 30 to 50% in the BSE 200.
Yeah. So the point is that, when you have these sort of deep corrections and unexpected corrections, you typically, what my own experience has been, that when you're in a normalized market without an extraordinary event like what COVID had, you do apply the stop loss approach, because out there a stock is falling without any macro reason governing it. But when you are in a approach like the Lehman Brothers approach, or when you are in something like we saw in COVID, you would typically sit through it, because as we saw, the bounce backs can be equally sharp, and the corrections can be hugely exaggerated, often based more on fear than rational reason. The important thing really for us is, as I mentioned to you when we did our previous study, which we can also share with you, is that those companies were identified based on the fact that they gave a 15% CAGR even though markets corrected and came back as such. So for these extraordinary drawdown periods, we would probably just stay invested based on the model.
The next question is on financials. While doing back testing, you have not included Yes Bank and ILFS. How could you have avoided investing in these during those times?
So that's a very good question, but let me answer that in a different form. They would probably have come at, sorry, you said Yes Bank and?
ILFS.
Well, ILFS was never listed, so it was never an option to invest in ILFS as such. But yes, Yes Bank, if you say, don't forget that the model is identifying companies based on growth and return on equity. In case of banks, we use return on equity as a parameter. Now, if you were to see that when the NBFC crisis started, Yes Bank's growth got impacted. It would have not even come up in the model. Okay, and typically banks or any of these companies didn't go down under overnight. There was a credit crunch, growth started faltering, and as growth started faltering and money flow stopped, these companies took their time before they went down under. Yes Bank episode happened now. Don't forget the global, the NBFC or the financial crisis started in September 18. And Yes had already started faltering during that period of time in terms of its numbers and return on equity. So it would have obviously now not come into that filter. However, it could have possibly come into a short-term filter, in which case, like I mentioned to you, in the absence of an event like what we saw, if a stock would come down consistently due to individual reasons. As I said, there is a research overlay which would have enabled us to apply the 20% stop loss filter.
Nitin, just to continue on the earlier question, could you give us more flavor on what kind of filters we have for financials and banks and NBFCs in specific?
So in terms of banks and NBFCs, we essentially look at their growth in terms of profitable growth, because that sort of encapsulates the quality of the book. We look at return on equity, and we look at the NII growth.
Right. While large cap valuations are currently expensive in the expensive zone, broader market still offers investment opportunities. Considering this as an investment house, would you recommend multi-cap strategy or a blue chip strategy at this point in time?
So look, when we look at valuations today, and we say valuations are expensive, we're looking at it based on what? Don't forget that valuations have two factors to it, right? There's a numerator. I mean, when you look at this P ratio, let's say, for example, it's got the price and it's got the earnings. You're coming on a artificially low earnings because you had the lockdowns from March and June and so on and so forth. Now, when you come back to your full earning growth potential, the E rises. Suddenly, the P remains where it is. The P is not that high any longer. So my own view is that, look, while you talk, I think that there are sectors of the economy where the large will continue to do well. I mean, if you take the financials, for example, I think you will see the leaders trading at premium valuations for considerable time to come. So you might have one phase of the rally where you had valuations go up, but the second phase of the rally, when you will start seeing growth come back, is also going to start contributing to your returns and so on and so forth. Now, to answer your broad question, yes, we think that the broader market also presents an opportunity as such, for which purpose we do have the growth and momentum portfolio, where we are investing at across the broad market spectrum. But this strategy, as I mentioned to you, approaches the market from a perspective that if your other fear is that, oh, markets are high, if you are not comfortable, then this is the place for you to be, because here you're looking at confirmed growth numbers, you're looking at growth upturn numbers that are happening. Because any company, as I said, which is showing 2-year numbers, generally continues that flow of growth for at least the next few years, and so on and so forth. So you're looking at confirmed growth numbers. So these blue chips will continue to deliver numbers. So in my own view, I don't think that one is going to happen at the cost of the other. But whether that happens or not, we really don't care, because don't forget that out of the 200 index, we are ultimately investing in that 35-40 names which are growing, even within the blue chips as such. So while blue chips might be high, and it's not like, for example, in this approach, you bought a blue chip, and so what happens is, like, you take an Asian Paints, for example. Like, it's a known fact that Asian Paints and companies like that have delivered their returns in very compressed periods of time for investors. But investors say, blue chip, let's just sit on it, because nobody knows when that compressed period of time will happen. And that is our endeavor out here, to be able to identify those compressed period of time and invest in those blue chips precisely at that moment. So while the broader market also presents opportunity, we do believe that blue chips of the caliber that we are talking of will also deliver growth. And frankly speaking, if you ask me, when we looked at the returns, compounded returns of this portfolio and compared it to the compounded returns of our existing portfolio. So like Deepak said, our existing portfolio has delivered 29.9%. This particular portfolio, when we look at the compounded return, that number works out to almost 25%. So clearly there is a 4% premium that we get for some of the small and mid-cap investing. But if you are comfortable with 25%, which by the way is a very handsome return historically, and the blue chip names, then it is a pure risk reward payoff that you as an individual investor need to take.
Nitin, will this strategy not hover around flagship mid-caps like PI Industries, etc.?
So, yes, you're right, because when you define the BSE 200, based on SEBI's definition, if you were to say, the 1 to 100 is the large cap category, and 101 to 250 is mid cap, right? So when you say the top 200 names, you're essentially coming to the larger mid caps out here. And yes, I will not be surprised because these companies have delivered solid, consistent numbers over periods of time. If, for example, in our current model, which has got thrown up, PI is very much there.
Right. Does backtesting always help, as the emotion and sentiments at the particular time is not considered while backtesting?
So, and that's precisely why when you follow a rules-based, model-based approach, you put emotions in check out here as such. So, and if you really look at it, what have we done? When you talk about emotion, could have only, in my view, affected the returns that we saw as such. But if you follow a pure rules-based approach, I mean, the portfolio is telling you, look, these are companies which are growing at this rate. These are companies which are using capital efficiently. These are companies which are throwing out cash flow. Now, historically, whatever be the timing, these are companies which have generated wealth over extended periods of time. And hence, when they show up in the next, they show up on your radar, and when you create a portfolio out of that, I mean, it is nothing which an emotional response to it can only affect the return more than anything else. And it is our endeavor that we will be following the model to the T, to the extent of almost 90-95%. The only overlay, as I said, is that if we find any particular negative connotation in any company, we will be filtering that out.
Have there been any mistakes or bad calls in this model, or does it have a 100% strike rate? I saw India Bulls in the portfolio. What is the extent of manual intervention allowed?
So the only manual intervention that is okay, if you talk about manual intervention, as I said, there are bad calls. For example, you will see in the portfolio the losers that we shared with you in the presentation as such. But they are bad calls not by virtue of possibly any manual intervention, but they are bad calls by virtue of maybe that company had either run up too much or faltered in terms of its earnings in the next 1 year, and so on and so forth, and hence delivered negative returns. But it was more than balanced by the company which delivered positive returns. So if you're asking me, what is the manual intervention? Yes, as I mentioned to you, no PSUs in the portfolio. When I refer to PSUs, means there will be no Coal India, there will be no SAIL, there will be no public sector banks, the old so-called PSUs. The only PSUs that we are referring to out here, as I mentioned, is the gas distribution companies, the power grid, not even NTPC, and so on and so forth, which will be a part of the portfolio. So no government company, no cyclicals. So no Tata Steel, no Hindalco, and so on and so forth in the portfolio, because we don't have the ability to forecast commodity cycles. So we want consistency in this portfolio as its hallmark. So no cyclicals into the portfolio. And to your response to of India Bulls in the portfolio, you're right. That's what the portfolio threw up. In our investing history, we have never invested in India Bulls so far in the 9 years as such, because of the quality of management. So yes, there will be an overlay of management quality that will sit on top of it. So wherever we know of known management quality defaulters, we will be overlaying. Oh, and there's one more overlay that will be there. No companies where shares are heavily pledged as such of promoters.
Nitin, at current valuations, are you betting on a correction? And do you think deploying proceeds in a stagger manner is the way to go?
So that's a very good question that you asked. And to be very honest with you, in our existing portfolio, which is the growth and momentum, that's how we are deploying money in a staggered manner. However, in this particular portfolio, it's going to follow a fully invested approach at all given points of time, because we don't want to tamper with the results of a model which has now over 9 years shown the kind of returns that it has shown. And further, even further, the quality of companies that are getting thrown out in this portfolio. So based on that, in this portfolio, unless an investor deems it otherwise and gives us specific instructions to that, to the contrary, this will be a fully invested portfolio.
Nitin, in your fund growth and momentum, did we sell out during the March and June COVID period? How prudent were we, and how did that perform? How did that performance do on your approach? Can we see a chart of growth and momentum fund for the period?
We can share that with you. I don't think we have it with us right now. But Varun, while we are talking, if you can put together a chart, that would be great. But so let me just tell you what we had done in the growth and momentum, and we've been sharing this with our investors in the last many months. So around January, February, we had increased our cash holding in the growth and momentum. We had made some changes in the portfolio at that time. What had we done? So we had got out of all retail-oriented and retail-focused companies. And that was the time when lockdown had not yet been imposed in India. But we had taken what we had seen at that time, if you remember Jan, February, Italy was all over the news in terms of the way the COVID virus was spreading and what was the situation. So we took a cue from that and we said, look, if it comes to India, it's going to be super challenging given our population density. So we completely eliminated retail oriented companies from our portfolio at that time. We had already, prior to that, in the post the NBFC crisis of 2018, we had in our financial portfolio, we had followed an approach of consolidation. So we said in the private banks, we only want the top 3-4 large private banks. In the NBFCs, we said we just want an HDFC because that's going to consolidate and take market leadership in the mortgage business, and a Bajaj Finserv. So, and further, we had reduced our financials to under 20%. In the index, they have a 30%, 35% weightage. So we had reduced that. Come March, we further increased our cash holding to roughly as high as 30% in the portfolio, which was very high. And what we did was that we deployed about 5% of that cash and we bought gold, because at that point of time in March, when lockdowns were imposed, I don't think anybody in their right mind really knew what is going to happen and what is the nature of this virus, and how bad can things get, and so on and so forth. So so we said gold offers as a good hedge. So we bought 5% of the portfolio into gold at that point of time, which by the way played out very well for us. And when the crash happened, what we did is we started buying selectively into a few MNC companies when the crash had happened. And we bought into companies we thought that whenever this whole thing is, so we retained a sizable amount of cash in the portfolio even in the month of April. I mean, we reduced the 70 and we had sort of bought it down. We increased the 70 to 80 and we brought down our cash to around 20% levels. But we invested and we created a portfolio which is the businesses which will first come back as soon as the lockdown is lifted and things start getting better. So we had invested in gas distribution companies, a sector on which we have been bullish for the last 2 years. We increased our weightage out there by buying into Gujarat Gas and Indraprastha Gas. We already had pharma, We didn't really go out and buy pharma just because pharma is a flavor. We want in that portfolio growth to be the parameter, even in such tough times. So we were holding granules for a long period of time, but we added a JB Chemicals out there because we knew that it was getting taken over by the management was in the market looking for a buyer, and so sooner or later a private equity player was going to take it over. So we bought into JB Pharma at that point of time. We within the financials, as I said, we had already consolidated and we preferred to increase our exposure to some of the financials, which really took a beating and so on and so forth. So as a result, that portfolio came back very strongly when the markets bounced back. In fact, I don't have the exact numbers, but I think in July, August, September, and Deepak can of course share that with you, but we were among the top performing PMSs at that period of time. But if my memory serves me right, when I last looked at the numbers, from the bottom of March end, in the current year, we actually have sort of been up close to 75% plus and so on and so forth. So the portfolio has done remarkably well. Yes, when it did fall, it fell more or less in line with the market. I think it was slightly less than the market. So we were able to not lose more than the market, and we bounced back in far excess of the market.
Nitin, will the portfolio therefore be rebalanced every year based on the last 12 months of growth?
So the portfolio will be rebalanced not every year, every half year. So when March and September, that's the time when companies declare the results and they also share their balance sheet. And as I said, we look at cash flows as also one of the most important facets. So every March and September is when we will be rebalancing the portfolio.
And will the growth be on the basis of the last 12 months?
It will be, as I said, based on the trailing 12 months. Not on 12 months, as I said, we look at 2-year growth numbers. So trailing 24 months, if I were to call it.
So Nitin, just giving the answer to the previous question for how we bounce back from March, I have actually 1-year number and 6 months number, not exactly 9 months number, but I think people can take reference from this. So 1 year market is down, market is up 9.2%. Our growth and momentum PMS is up 36.8%. So that's a huge 26% outperformance or 27% outperformance for 1 year. And in 6 months, market is up 37% and portfolio is up 49%. So again, 12% outperformance for 6 months. So I believe 9 months should also be in similar lines. Thanks.
Yes. Nitin, in your model portfolio, there are 1-2 companies which are consistent. PMSs are known to buy companies which with growth parameters. How are you going to buy the newer stocks and sell off another stock which yet maintains the growth prospects?
So, like I said, this what you saw in this portfolio was approach of investing in 20 companies and sort of doing a uniform allocation across these 20 companies. So what will happen is that whenever the rebalancing happens at every half year, if there is a company which, say, for example, was at a 5% weight and has now gone to 7% weight because of appreciation in stock price, and it again shows up in the new portfolio. So it will get rebalanced again in terms of the fact that the new portfolio value is up and it will be 5% of the new portfolio. So whatever will be a little excess might be trimmed as in terms of the profit booking that will take place. But in terms of consistency, in terms of it will be rebalanced into the form of having an equal weight across all the 20 stocks in the portfolio.
So the next question is in growth and momentum has a few large caps. Will they continue to find place in Tru Blu?
If they meet the criteria of the rules that have been set to establish the Tru Blu portfolio, they will be there. If they don't, they will not be there.
Nitin, will it not result in excluding sectors like pharma, internet companies, insurance? Most of them are better placed now.
Actually, why should they exclude? In fact, you would be surprised in our current portfolio that we are looking to put on. We have an embarrassment of pharma in that. In fact, we are trying to see how we can reduce pharma because there's just too many companies that have got thrown. Ultimately, look, the portfolio model is a slave to the numbers. If there is a sector or there are companies who are growing, the companies have to fight to occupy their position in that portfolio as such. If pharma is growing, pharma will be there. If IT is growing, IT will be there. In fact, in our June portfolio of the current year, we have seen IT predominate out there, pharma predominate out there, agrochemicals predominate out there, all sectors which are growing.
Nitin, FIS sold 29 billion in Philippines and Taiwan. Do you expect similar in India? Can mutual fund NFO collections cushion the fall?
I wish I could answer your question comprehensively. The answer is why are FIs buying the way they are buying? I think very clearly they are looking at India from a growth perspective. India's growth has been far stronger than everybody's expectation. And if you remember, when we were going down, IMF initially said, "Oh well, India will yet grow at 1-2%." Then they said Then they kept on downgrading downwards. Similarly, now the upgrades are happening upwards. Initially 11%, then they said 9% negative, then they said 7% negative. So frankly, in such an environment, nobody really knows or is able to call the shots. My own belief is that given the way the kind of FDI India has been able to lure in from foreign investors, you're seeing the kind of response which IPOs have been getting from FPIs and HNI clients. I think India will continue to remain favorable. And if you look at the 20-year, India has never seen that kind of sellout, the kind of sellout that we saw for that limited period, let's say during the February-March pandemic, during that time. Besides that, in 20 years, India has never, even during the Lehman Brothers, we never saw that kind of sellout. And if you've had, say, for example, roughly, I think last month we had close to 65 or 70,000 crores. This month, again, there has been a large amount. Now, if you have 4-5 billion going out intermittently, and that causes the 10% correction, surely, I mean, don't forget, the amount of FOMO that I see in this market is absolutely unbelievable. If this market were to correct 10%, there are more than enough people who are waiting on the sidelines who are ready to jump in because they missed it. People have been, since July, August, we've been holding webinars for all our clients. And the same question, well, markets have run up, Now think about it. Somebody's saying that 10,500 market has run up, 11,500 market has run up, 12,500 market. Even if from 12,500 or 13,000 the markets were to correct 10%, that guy at 10,500 or 11,000 was saying market has run up and waiting for a correction. It is, nobody ever knows these things. And the point is this, let's look at it from a pure fundamental perspective. That's why if we get too obsessed with markets, we will never be able to invest in markets. Let me tell you that. Because we are talking of active investing here. We are not talking of passive investing as such. Okay, passive investing in India has not delivered the returns that it should have all these years, because India has always been and continues to be a bottom-up market. Now, we can obsess over FII investment going, this happening, that happening. Fine, you do that. My job is to identify companies. My job is to deliver returns. We have done that over 9 years, and we will continue to do that 9 years. I cannot allow this noise. If I get caught in this noise, I can't invest.
And then which stock did you sell in March 2020 correction?
Which stock today? I said, like I mentioned to you, we reduced our weightages to the financials as such by selling almost every financial pro rata. And we sort of consolidated all of it in just about 5 or 6 names within the whole financial NBFC sector. So we trimmed every financial we trimmed, whether we had a Kotak, whether we had Access is one we got out completely. If you're asking me that specific question. We got out of Axis completely. NBFCs, any which way, we were only in Bajaj. So we trimmed a little bit of Bajaj Finserv at that time. We had Inox Leisure in our portfolio, which we got out of lock, stock and barrel. We had, which is the other retail name that we had in our portfolio? We had Phoenix, yeah. So we had Phoenix, we got out of Phoenix. So all these so-called retail-oriented exposure stocks, we completely got out at that time. And frankly, we didn't do a lot after that because our portfolio was very resilient. So in our pharma, for example, we had, like I mentioned to you, granules, we kept on holding on to it. We had IGL in our gas companies. We had Gujarat Gas. We had UPL at that time also in our portfolio, which we held on to. We had Weber Global. So we pretty much didn't do too much of this thing because our companies were good. They were delivering numbers. They didn't have debt. So, I think the 2018 NBFC crisis to me was a bigger lesson than March 20. That 2018 crisis, when the economy started tightening and credit started tightening, we brought in a number of changes at that time in our portfolio, in our approach, wherein we said, when we removed all companies with pledges out of our portfolio, we looked at companies with working capital cycles less than 90 days to be there in our portfolio. Essentially, so when we did all of that stuff at that point of time, that created a solid portfolio. In fact, you see, in all our 9-year history, September 18, I think, was a watershed year for us, a month for us, because that's where we learned our maximum lessons, and we reoriented the portfolio so strongly that we didn't really have to do much. We didn't run around helter-skelter. In fact, we were so damn confident of the stocks we had in March 18. All we did is we raised some cash, we reduced the financials, and we bought back those financials, by the way, because they were good financials. But we thought that, look, when there's a lockdown and the government imposes a moratorium on payments, we don't know what the extent of the problem. Even the businesses didn't know. So we just took a prudent measure by reducing our financial weight, and we continue to own those financials. So if you really see, 70% of our portfolio or 75% of the portfolio continues to be what it was in February, March, as such. And that is what a portfolio should be. You can't just be, running around like a rabbit and, saying, oh, I'll make mass changes now and then. Your portfolio has to show companies which have resilience in them, which will meet these downturns. And that's how we met March. So I'm not worried about March. To me, September 18 was a bigger learning than March 20.
Nitin, how will you include sunrise or new sectors like healthcare, insurance, digital, staffing, as they do not have enough track record of financials?
So they will not be there. As I said here, this is a portfolio which looks at companies. They will come into the portfolio probably at a later date where they have shown established track record. But look, growth and momentum always has a place for them.
Right, Nitin. That was the last question. I invite you and Deepak for your closing comments.
So I thank you all for your participation. I thank you all for your interest. We think that Tru Blu does not come at the expense of growth and momentum. There is a place for both in the wealth allocation that takes place. Like I mentioned to you, one has a more of a higher growth but more mid and small cap orientation, although it has a decent amount of large cap also in it, the growth and momentum. The other one looks for established delivery models which are working and have shown results to be invested into. We've seen both approaches deliver very handsome returns over periods of time. Although I would say that the Tru Blu portfolio has lower volatility compared to the growth and momentum portfolio. So I think there is a place in it for both in a prudent asset allocation model as such, and we feel, especially in today's time and place where people are so continue to remain apprehensive of the valuations and the market and so on and so forth. We think that Tru Blu could actually be that answer where you could sort of invest in and with lower volatility. Yeah. Thank you. Over to you, Deepak.
So I also want to thank all our partners and investors who have taken the time out and come today. Do look at this strategy. Me and my team will be providing you more information. As such, I don't know whether all of you are aware, but if you look at the PMS Bazaar magazine, where there are more than 165 PMSs, if you see growth and momentum's performance over the last 9, 8, 7, 6, 5, 4-year period, you will either find the product either number one or number two. There are hardly any PMSs that have done so well over this long period of time, and even on shorter periods, for example, 3 year, 2 years, 6 months, and 3 months, you would find that we are in the top 10 or 20 percentile, which again is a very, very difficult task to achieve for such a long period of time. So all kudos to Nitin, Varun, and Jay, the team who've been managing this for such a long period of time. And I believe the AUM that we currently manage and the number of clients that we have does not do justice to the performance of the fund. And it's upon us, the partners, and the team at SATCO Wealth to take it forward to each and every client. So thank you very much for coming on today on this call. We'll be in touch. Thank you.